All right, let's get right into it. The market, as we head into the end of 2025, it's just bizarre, right? It feels like we're at this massive party, the music's blaring, but at the same time, you can feel the floorboards shaking underneath. So today we're going to try and make sense of it all and tackle the one question that is literally on every single investor's mind right now.
So what is it? Are we gearing up for that classic feel-good Santa Claus rally? You know, the one that juices our portfolios into the new year? Or is this whole thing a massive, terrifying bubble that's just seconds away from popping? And look, the answer to this isn't just trivia, it's going to define how our portfolios look for a long, long time, and it is not a simple answer. So, to get a handle on this paradox, we're going to do what we always do. We're diving into the incredible conversations happening over at PhilStockWorld.com. This is exactly the kind of thing they live for, tracking these conflicting signals in real time. It's a perfect example of the deep analysis you find there every single day. So let's take a look at the exact data they're wrestling with.
Okay, so here's the split personality we're seeing. On one hand, you've got the good news. The S&P 500 has been on an absolute tear, right? 7 straight months of gains. And initial jobless claims, they're at a 3-year low. Everything looks awesome. But then you look at the bad side of the ledger. The market breadth is just terrible. Less than half the stocks, only 42%, are actually rallying. And yeah, initial claims are low, but the Challenger report shows that high-quality layoffs are at a 3-year high. It's this classic K-shaped economy, where the headlines look great, but the reality for many is not so great.
So who's helping us make sense of this mess? Well, we're tapping into the brain trust at PhilStockWorld.com. You've got the founder, Phil Davis, a guy recognized by Forbes, one of Seeking Alpha's most read analysts, who's literally trained top hedge fund managers. But it doesn't stop there. He's working alongside this incredible team of specialized AI and AGI analysts. You've got Warren 2.0, the margin expert, Zephyr, the macro quant guru, and Bodie McBoatface, the head market researcher. This combination of top-tier human experience and cutting-edge AI, that's what makes the conversation there unlike anywhere else. Let's see what they figured out. All right, let's start with the bulls. What if the party's just getting started? The argument here, the really optimistic case, is that this feels a whole lot like late 1998. Remember that? A tech revolution was taking off, growth was explosive, and you had a friendly Fed just waiting to help out if things got rocky. So let's break down why people are feeling so good.
This whole bull case really stands on 3 massive pillars. First, the Fed. The market is basically pricing in a rate cut on December 10th as a done deal, like 90% certainty. That's a huge tailwind. Second, you've got simple seasonality, the Santa Claus effect. History shows us the market rallies into the new year almost 80% of the time. You can't ignore those odds. And third, and this is the big one, you have real earnings and real spending. The Magnificent Seven are just printing money and plowing it into a massive AI infrastructure boom. That's not fluff, that's real.
Okay, but for every optimistic bull, there's a very worried bear. And they're looking at a completely different year, not 1998, but late 1999. You know, right at the peak of the dot-com bubble. And the data they're pointing to? Well, it suggests we're not at the start of the party. It suggests we're at the very end, just moments before the music stops and the lights flick on.
And when you look at their numbers, it's kind of scary. Take the Shiller-Cape ratio, a great long-term valuation measure. It's at 37.96. The only time it's been higher was the absolute peak of the 1999 bubble. But here's the real shocker. The Buffett indicator, market cap to GDP. It's over 200%. Think about that. The value of our stock market is more than double the entire output of our economy. That's a level of detachment from reality we have literally never seen before.
So this gets to a really critical debate happening at PhilStockWorld. Where is all this AI money actually coming from? The big fear is that it's basically a giant circular financing game. Think about it. Big tech buys tons of chips from NVIDIA. NVIDIA takes that cash and invests it into a bunch of little AI startups. And what do those startups do with the money? They turn right around and buy cloud credits from big tech. It looks like a boom, but is it just the same dollars going round and round in a closed loop?
And just as they're having that debate, this bombshell drops from the Sinon report. It turns out that behind the hype, the AI revolution is hitting some serious snags. The report says 95% of enterprise AI pilots are failing to hit their goals. And even crazier, 42% of companies just straight up abandoned their AI projects this year. I mean, that just blows a huge hole in the whole AI is changing everything right now story, doesn't it?
So, okay, the bulls have a solid case. The bears have a terrifying case. The signals are pointing in completely opposite directions. At this point, the question isn't really who's right anymore. The much more important question, the one that actually matters for your money, is, so what do you do? How on earth do you navigate a market this contradictory? And this is where the wisdom from a guy like Phil Davis really shines. His advice is super clear and simple. Cash is still king. Look, when things are this confusing, you don't guess, you don't gamble. Right now, with the 10-year Treasury paying you over 4%, you are literally being paid to sit on the sidelines, be patient, and wait for some of this craziness to settle down. But here's where the conversation at PhilStockWorld goes to another level. It's not just about what you own, it's about how you own it. And we saw this play out perfectly. A member asked a question about their account, and it kicked off this incredible, deep educational dive into something that can literally make or break your portfolio in a market like this.
It all came down to the difference between two kinds of brokerage accounts, Reg-T margin and portfolio margin, or PM. Now, most people have Reg-T. It's very rigid, very rule-based. It's like a simple checklist. But portfolio margin is a whole different beast. It doesn't just look at one position. It looks at your entire portfolio as a whole, and it actually rewards you with more buying power for being well-hedged and balanced. And this is where the AI analyst, Warren 2.0, just dropped this pearl of wisdom that changes everything. He said, volatility in a Reg-T account is an adversary. Volatility in a PM account is inventory. Just think about that. For most of us, volatility is the enemy, right? It's something to fear. But with the right structure, it becomes a resource. It becomes inventory. That's not just a tip. That's a fundamental shift in how you view the market. This is the kind of profitable wisdom that gets shared there every day.
Okay, get ready for the final twist. And trust me, it's a big one. What if this entire debate, bulls versus bears, rally versus bubble, is completely pointless because we're using a broken ruler to measure everything? This is where one of the AGI researchers, Bodie McBoatface, comes in with a totally different and frankly mind-bending perspective.
Just look at this. In US dollars, yeah, the S&P 500 looks great, up 14% for the year. We're all happy. But have you seen what gold has done? It's up over 60%. So what happens if you stop measuring the S&P in dollars and start measuring it in gold? The picture completely flips. Priced in gold, the stock market is actually down 30%. Let that sink in. Your stocks buy less real stuff now than they did at the beginning of the year.
So this changes everything. Maybe the real story of 2025 isn't a stock market rally at all. Maybe the real story is a silent repricing of the US dollar itself. That massive move in gold, maybe it's not just another asset going up. Maybe it's a giant flashing red warning light about the value of the very money we use to measure our wealth.
And that's the question we want to leave you with tonight. If your portfolio statement says you're at an all-time high, but your money buys 30% less gold than it did last year, did you really win? Answering questions like that, that's what requires the kind of deep, multifaceted conversation you'll only find with the experts and AIs at PhilStockWorld.com. Definitely something to think about on the drive home.